Welcome to our comprehensive AUD/USD analysis covering November 17th to 22nd, 2025. This week presented a fascinating case study in currency market dynamics, where strong domestic fundamentals collided with overwhelming global risk sentiment. The Australian dollar emerged as the second worst performer among G10 currencies, declining 1.13% despite hawkish Reserve Bank positioning and robust economic data. Our analysis draws from multiple authoritative sources, including TradingView, Action Forex, Forex.com, and Daily Forex, providing you with institutional-grade insights. We'll examine the critical disconnect between Australia's economic strength and currency weakness, explore the extraordinary uncertainty surrounding Federal Reserve policy, and deliver actionable trading strategies for both short-term and medium-term horizons. Let's dive into the key factors that shaped AUD/USD performance this week and what they mean for traders going forward. Australian dollar to US dollar delivered a disappointing performance this week, falling 1.13% to rank as the second worst G10 currency. What makes this decline particularly noteworthy is the remarkably tight trading range from Tuesday through Friday, just 15 pips, suggesting market participants were paralyzed by uncertainty. The Australian dollar's high correlation with equity markets, ranging from 0.7 to 0.9 with the S&P 500, proved devastating as AI bubble fears triggered the largest equity reversal since April. Global risk-off sentiment completely overwhelmed positive domestic factors. Despite the Reserve Bank of Australia maintaining a hawkish stance and Australian economic data exceeding expectations, the Aussie couldn't escape the gravitational pull of deteriorating risk appetite. This disconnect between fundamentals and price action highlights how external factors can dominate currency movements, even when domestic conditions remain supportive. The week exemplified the challenges facing commodity currencies in an environment of heightened global uncertainty. Australia delivered a trio of positive economic releases that would typically support the currency, yet AUD/USD barely reacted. The wage price index came in at 0.8% quarter-on-quarter, perfectly in line with Reserve Bank forecasts, confirming wage pressures remain elevated but manageable. More impressively, the manufacturing PMI surged to 51.6 from 49.7, returning to expansion territory after contracting below 50. The services PMI also strengthened to 52.7 from 52.5, demonstrating continued growth momentum. The composite PMI reading of 52.6 confirmed broad-based economic resilience across both manufacturing and services sectors. Under normal circumstances, this combination of solid wage growth and expanding business activity would provide meaningful support for the Australian dollar. However, the market's complete indifference to these positive surprises underscores how global risk sentiment dominated all other considerations. Domestic economic strength simply couldn't compete with external headwinds this week. The Reserve Bank of Australia's policy outlook shifted dramatically hawkish, with December rate cut odds collapsing to just 8%, down from significantly higher expectations earlier. Markets have largely abandoned the idea of near-term RBA easing, with the futures curve now favoring a single 25 basis point cut by mid-2026. This hawkish repricing reflects several powerful factors: exceptionally strong employment growth, elevated inflation that remains above target, and Q3 home loans hitting record highs, particularly among property investors. Perhaps most striking is the emerging narrative that the RBA's next move could be a rate hike rather than a cut, a complete reversal from earlier expectations. This creates a significant policy divergence, with the RBA maintaining a hawkish stance while other major central banks contemplate further easing. Theoretically, this divergence should strongly support the Australian dollar. Yet global risk sentiment overwhelmed this fundamental positive during the week, demonstrating how external factors can temporarily override even the most supportive domestic monetary policy positioning. The longest ever U.S. federal government shutdown created extraordinary complications for economic data and policy decisions. The $11 billion economic cost extends far beyond the immediate fiscal impact. Agencies are now backfilling weeks of missed reports, with errors and revisions expected in delayed releases. Data flow won't normalize for several weeks, creating a fog of uncertainty precisely when clarity is most needed. The Philadelphia Fed Manufacturing Index contracted at the fastest pace in 6 months, though interpreting this data requires caution given the disruptions. Most critically, the Federal Reserve faces an unprecedented challenge entering its December 9th to 10th meeting. Policymakers will lack access to November CPI and employment data due to the shutdown aftermath. This forces consequential monetary policy decisions based on incomplete information. The Fed must choose between taking another insurance rate cut in the dark or waiting for fuller information at the risk of falling behind the curve. This data vacuum transforms what should be a data-driven decision into a judgment call with extraordinary uncertainty. Federal Reserve policy expectations whipsawed wildly this week, with December rate cut odds swinging between 35% and 70%, an extraordinary range reflecting deep market confusion. Hawkish factors initially dominated. FOMC minutes revealed many participants favored holding rates, solid September employment data persisted, and inflation concerns remained elevated. These factors drove cut odds down to 35%. However, New York Fed President Williams then opened the door to near-term adjustment, suggesting room to bring policy closer to neutral, which sent cut odds rebounding above 70%. The incomplete data situation due to the government shutdown amplifies this uncertainty. The Fed enters its December meeting without November's CPI or employment data, the two most critical inputs for monetary policy decisions. This creates an unprecedented situation where policymakers must make consequential decisions based on incomplete information. For AUD/USD traders, this Fed uncertainty adds another layer of complexity to an already challenging environment as the direction of U.S. monetary policy remains genuinely unclear. Australian dollar per US dollar remains trapped in a well-defined technical range, with clear support and resistance levels constraining price action. On the resistance side, 0.6550 represents the critical descending trend line. A break above this level would signal a potential trend reversal. Secondary resistance sits at 0.6580, with psychological resistance at 0.6600 near July highs and extended targets at 0.6615. On the support side, the 200-day moving average at 0.6470 provides critical support. This level has held multiple tests and represents the line in the sand for bulls. Secondary support at 0.6440 offers additional cushion, with the swing area between 0.6407 and 0.6424 providing deeper support and the major psychological level of 0.6400 as the ultimate downside target. Technical ratings reflect this indecision. Overall neutral, but 1-week rating shows strong sell, 1-month rating shows sell, and MACD signals bearish divergence. The market awaits a catalyst to break this range. For the next 1 to 2 weeks, we assign 3 scenarios with varying probabilities. The base case, 50% probability, sees continued range-bound trading between 0.6400 and 0.6600. The 200-day moving average at 0.6470 should provide support, while 0.6550 resistance caps rallies. The market awaits the Federal Reserve meeting catalyst. The bearish scenario, 30% probability, targets 0.6300 to 0.6400 on a break below support. Triggers include intensifying risk-off sentiment, hawkish Fed policy, or deepening China weakness. Technically, a break below the 200-day moving average would confirm the downtrend. The bullish scenario, 20% probability, targets 0.6600 to 0.6615 on a break above resistance. This requires improving risk sentiment or confirmed Fed cuts. Technically, a break above 0.6550 would trigger short covering. The key catalyst is the Federal Reserve meeting December 9th to 10th, which could provide the directional impulse this range-bound market desperately needs. Looking 1 to 3 months ahead, we favor a cautiously bullish outlook, with 45% probability for recovery to 0.6650 to 0.6800. This scenario assumes RBA-FED policy divergence plays out as expected. The Reserve Bank maintains its hawkish stance while the Federal Reserve continues easing. Additional drivers include stabilizing risk sentiment, Australian economic resilience, and the 200-day moving average holding as support. Scenario 2, 35% probability, sees extended range trading between 0.6300 and 0.6600 if factors balance out: policy divergence offset by China concerns, mixed risk sentiment, and sideways commodity prices. Scenario 3, 20% probability, targets a bearish breakdown to 0.6200 to 0.6300 if risk-off intensifies. Triggers include severe equity correction, deepening China slowdown, hawkish Fed surprise, or technical break below 0.6400. The key pivot level is 0.6550. A break above signals medium-term bullish reversal and validates the policy divergence thesis. Downside risks include sustained equity market weakness driven by AI bubble fears, China economic deterioration, hawkish Fed policy surprise, technical break below 0.6400, commodity price weakness, and escalating global trade tensions. Upside risks include improving risk sentiment, RBA hike signals, confirmed Fed December cut, China stimulus measures, commodity price strength, and technical break above 0.6550. For trading strategies, trend traders should sell rallies to 0.6520 to 0.6550, with stops above 0.6570, targeting 0.6400 and 0.6300 for risk, reward of 1 to 2 up to 1 to 5. Range traders should buy 0.6440 to 0.6470 and sell 0.653, 0 to 0.6550, with stops beyond range boundaries for risk reward of 1 to 1.5 up to 1 to 2.5. Swing traders should wait for breakout confirmation, enter on retest of broken levels, use 50 to 80 pip stops, and target extensions. Critical risk management. Position size 1 to 2% maximum per trade. Use stop-loss orders religiously. Take partial profits at key technical levels. Avoid overtrading mid-range. Capital preservation is paramount given elevated uncertainty.